Welcome to Henrik Curran's Super Insights. In today's session, we'll tell you all you need to know about self-managed super funds. Your presenter is Chris Campbell, partner of our Superannuation division. Enjoy the session.
Hi everyone, my name's Chris Campbell, partner of Superannuation at Henrik Curran. An overview of what we're going to talk about today: why save using superannuation, what are the types of super funds available in Australia, and then looking at self-managed funds, what's involved in setting up a self-managed super fund, running the fund, and what are the advantages of having your own self-managed fund. And this leads up to helping you make an informed decision on whether or not SMSF is right for you. So, why save using superannuation? So, just a word about saving. Why do we save? Well, we have to spend money on our living and lifestyle choices and raising a family, cars, those sort of things. But when we retire, income stops. So who's going to pay for your retirement? Is it the government or you? So if you've got parents or grandparents, they're probably saying to you, save, save, save. And your family and the television and everyone else in the world is saying, spend, spend, spend. So the government's constantly telling us that they can't afford to pay us all the age pension when we retire, and that'll become more and more difficult in successive generations. So they need to encourage us to build up private savings through investment. So how do they do that? Well, first of all, there's compulsory employer superannuation support, the superannuation guarantee, which those of us that are working for an employer will have contributions being put away for us for our retirement. And then there are general tax concessions that then encourage savings. So negative gearing is a tax concession, mostly used on purchasing of property. Dividend imputation, refund of tax paid by companies on their dividends. And superannuation, of course, which is another tax concession. So the superannuation guarantee is the employer-funded retirement. So employers need to pay contributions for employees. Currently that rate is 9.5% of your earnings, and given recent government's announcements, that rate will be frozen at 9.5% for the next few years to come. So voluntary superannuation saving is the other way the government encourages us to contribute to superannuation. Now that's over and above the 9.5% compulsory rate that employers pay. That's called salary sacrifice, where you devote some of your salary to superannuation contributions. Self-employed people are also entitled for tax deductions against their business income for superannuation contributions. And the other encouragements are low rates of tax on the earnings by superannuation funds while the investments are accumulating during your working life. And then in retirement, tax-free lump sums or pensions when you retire after age 60. An important starting point is firstly deciding whether superannuation is the right tax concession for you. As I said, we have negative gearing, there's dividend imputation, and the superannuation. Negative gearing and dividend imputation is typically personal investing, and the tax rates there are up to 49% at the top level. Whereas in superannuation, while you're accumulating, the tax on investment income is 15%, but then when you retire and you're drawing a superannuation pension, the tax on investment income of the superannuation fund is nil. So it's tax-free investment earnings. So the big trade-off, if you'd like to call it that, with superannuation is that you usually get better tax savings, but you can't spend that money until retirement. That's your big decision with superannuation. If you look at the amount of money Australia's already saved in superannuation, it's about $1.85 trillion. And on the pie chart there, you can see the various types of superannuation funds, from the government public sector to the industry funds and retail funds, corporate funds, and self-managed funds, which you can see is There are currently about 535,000 self-managed funds in Australia, and amazingly they control a third of Australia's superannuation wealth, and all that being in probably around about 1 million members. If you're an employee or an employed director of your own company, you'll be contributing for yourself and for your employees to a default superannuation fund, which is called a MySuper product. Now, these are large superannuation funds. They provide minimum levels of life insurance cover, and they're regulated on what they can charge as direct member fees. So that includes industry funds, retail and corporate funds. So you can also choose your own fund. That's any other fund that other than what the employer is offering, and that includes self-managed funds. And in a self-managed fund or a fund of choice, there's no minimum requirements for insurance or fees. And the self-employed can choose any type of complying super fund, including self-managed. So if we look at all the superannuation funds that we have in Australia, and let's put self-managed funds all into one basket, and all the others we'll call public offer superannuation funds. Look at a public offer superannuation fund, it probably has thousands and thousands of members, whereas if you look at a self-managed fund, it typically only has 2 members, hence called mum and dad funds. And if a large public offer fund had $30 million, then a self-managed fund only has your share of that, which might be around $300,000. And an SMSF have up to 4 members, but as I said, typically they either have 2 members called mum and dad funds, or 1 person on their own. SMSF invest in. Well, the answer is most investments, subject to some restrictions like lending money to yourself from your self-managed fund or your relatives or to your business. This money's for retirement and not for your personal use. But typical SMSF investments are cash, fixed interests, bonds, term deposits, also listed shares on the Australian Stock Exchange, and of course real estate. Money into an SMSF. Well, contributions is the primary method, so by your employer, as I said, the superannuation guarantee, compulsory contributions, or by salary sacrificing, more contributions into super. You can make personal contributions from your private savings, or you might roll over other superannuation from other funds that you're in. Question often asked is how much can be contributed, and the answer is that contribution caps apply to each individual. Now we'll look at those amounts a little later, but basically they're broken up into 2 categories: concessional, which are tax deductible contributions, and non-concessional, no tax deduction claimed, and from your personal savings. Establish a self-managed superannuation fund. So once you decide that you want a self-managed fund, this is how we proceed. We get lawyers to draw up a trust deed, which becomes the governing rules of the self-managed fund. So a self-managed fund must have a trustee, and that can be either individuals or a company. The prospective members and trustees, you will sign the trust deed and create the self-managed fund. It's then registered with the tax office and receives its own business number and tax file number. Then you simply open a bank account for the self-managed fund in its name at your bank or the bank of your choice. Then you roll over benefits from other funds or make contributions into the self-managed fund bank account. You may exercise a choice of fund to have your employer contribute to your self-managed fund. You then formulate an investment strategy and you begin investing. Away you go. Just in that list of things in establishing a self-managed fund, particularly 5 and 6 I wanted to talk about. When you roll over benefits from other funds or exercise a choice of fund to have your employer contribute to your fund, there's a couple of words of caution. So if you roll over some or all of your super benefits from your large fund, you may lose your life insurance cover in that fund. Also, with some funds, if you reduce or stop your employer contributions to a large fund and make them into a self-managed fund instead, you may lose your life insurance entitlements in that large fund as well. So it's important that life insurance cover can be transferred to your self-managed fund and can be preserved without the need for you having to go through medical tests. So that's a good starting point in your decision about an SMSF to review your insurances. And you'll probably need a licensed insurance professional to advise and assist you with transferring life insurance cover and helping you through that decision process. So I mentioned before that a self-managed fund can have up to 4 members, but typically we see 2 members, a mum and a dad. So who else can be a member? Adult children are often considered, but let me give you a couple of words of caution. Superannuation in any fund, small or large, is a marital asset that can be split on divorce or even in de facto separation. So you need to consider that if one of your children becomes divorced or separated and they're a member of your self-managed fund, that your fund could get dragged into those proceedings, something that isn't very palatable. Also, children don't inherit your superannuation just by being a member of your fund. That's a common misconception. So on death of the last surviving member, all remaining benefits have to be paid out of the fund. So typically that goes to the surviving spouse's estate. It can't stay in the super fund for your children to inherit. So what about your business partners? Well, I've seen it done, and it's a recipe for disaster. So your business partners could be in the fund with you, but if one of them has a divorce, or more likely you have a business partnership breakdown, then you can be at loggerheads, and that can be a disaster. Your unrelated employees? No, you can't put your employees into your self-managed fund. Each fund must have a trustee, and as required by law, the trustees are in fact the members. The trustee's responsibility is then to invest on behalf of the members, receive contributions from the members or their employers, pay benefits to members when they retire, and pay taxes and expenses of the self-managed fund, and reporting to members and to the ATO once a year. And all of that within the rules of the SIS Act and regulations, the Income Tax Acts, and various other state-based laws and the super guarantee laws. We said that a self-managed superannuation fund has to have a trustee, so we need to look at who can be a trustee and who must be a trustee. So the trustee can be at least 2 individuals or a company. So all members of a self-managed fund must be a trustee, or they must be a director of the trustee company. So they all need to be involved in the decision-making of the fund. Now what about a single member? Well, you can have another individual trustee to satisfy that requirement for 2 individuals, and that second person is not required to become a member of the fund. But that's only if you have 1 member. What people in this situation tend to do is have a company and be the sole director of that company, and then they can be the sole member and make all the decisions themselves. You have individual trustees or create a company trustee. Well, having individual trustees is cheaper because a company costs money to buy initially and then maintain every year. However, a company can be better for a few reasons. Estate planning particularly. A company continues on seamlessly after the death of a member director, whereas individual trustees need to be replaced, and typically that requires legal intervention to appoint that new person. A company also can ensure succession to the role of trustee when you die. Now that can be important where you don't want to leave your super to say a spouse from a current marriage, you want to leave it to your children from a previous marriage. So ensuring that the right person is in charge of your self-managed fund after you die is efficiently achieved by using a company as trustee. And as I said, administrative ease. You don't want to be running to the bank, changing the investment names and getting trust deeds executed if you have individual trustees at probably the worst time when a loved one has just passed away. Also, companies have limited liability. If you have a property in your fund and a tradesman hurts himself and it's your negligence and the insurance doesn't cover it, the trustees are liable. So a company has limited liability. And if you're contemplating borrowing in your self-managed fund, which is something we'll talk about later, the banks generally want a company to be the trustee of the self-managed fund. So what are the requirements to be a trustee? Well, you must be over 18 years of age. You can't be under a legal disability, insanity, or a guardian appointed. You can't be insolvent, having financial problems, such as bankruptcy. You're not allowed to be the trustee of your own self-managed fund. And you can't have any convictions in respect of dishonest conduct. So the ATO regulates self-managed funds and make sure they stay on the straight and narrow. And in fact, when you become a trustee of a self-managed fund, you have to make a declaration to the ATO that you're eligible to be a trustee or a trustee director, as we went through above, and to accept and understand the responsibilities of being a self-managed trustee director. So that's what you have to attest to. So from the ATO's perspective, they're charged with making sure self-managed funds do the right thing and save your superannuation for retirement. So they believe self-managed super fund trustee education is very important. And for people who have a self-managed fund and demonstrate that they're not following the rules, the ATO policy is those people probably shouldn't have a self-managed fund and we're better off back in the public office system. So building from that, there's an SMSF penalty regime which came in from 1 July 2014. If you do break the rules, what will the ATO do? Well, they can tell you to fix the problem. They can tell the trustees to go and take an approved course of education, or they can impose a monetary penalty for what you did, depending on its seriousness and whether or not you will comply with their request to rectify the problem. Now that we've scared you with those penalties, what are these rules that potentially you could break? Well, they're not really that bad. They're called the operating standards. But if you look at the first one, the sole purpose of the fund is to provide retirement benefits for you when you retire or for your dependents in the event of your death. And that pretty much sums up what a self-managed fund is about. As I said, you can only have 4 members in a self-managed fund, and all members have to be the trustees or the directors of the trustee company. There are rules about accepting contributions based on age is a typical example. Payment of benefits. Benefits can only be paid when someone satisfies a condition of release. Typically, again, that's retirement or reaching age 65, but it can also happen when someone's disabled, terminally ill, or when they die. The reporting obligations. So you need to value the assets of the fund every year and prepare financial statements. There's an extensive return to the tax department, not just about income of the fund, but some of the information about what you've been up to with the investments. And there are minutes and resolutions and meetings of the trustees of the fund. There also is a requirement to have a written investment strategy, which must be reviewed regularly and maintained. So your thoughts on investment have to be written down. The investment restrictions. Now, one of the big ones, which makes a lot of sense, is that you can't lend the money from the self-managed fund to yourself or to your relatives. There's restricted lending to related entities. That's called in-house assets. Now, a related entity would be, say, your business run by a company or a trust. Now, you cannot make a loan or an investment in a related entity that exceeds 5% of the market value of the self-managed fund. Even if you comply with that first requirement, any investment or loan must be on arm's length terms, interest rates, written agreements, what have you. And you can't invest in a related entity within these limits and then on-lend the money to yourself or your relatives. That's seen as anti-avoidance. Also, artwork. Some people like to invest in paintings. The requirements there, they must be separately insured within 7 days after purchase. They can't be kept at your home, and as you can see in the picture there, you're not allowed to enjoy them because that's a benefit before you retire. Also, you're not allowed to purchase investments that you currently own. Well, your self-managed fund can't purchase those investments from you. A typical example would be if you own a residential rental property and you want to sell it to your self-managed fund. That's not permitted. Also, if you have a self-managed fund and it invests in residential property, it can't rent that to you, not even for holidays, or to your relatives, within the rules. Now, there are some important exceptions, and we'll touch on these later, but a self-managed fund can acquire business real property from a member or related party. So, provided you've got a business premises, no residential component of it, and you acquire it at market value, your super fund may be able to purchase that property. It can then lease it back to your business at an arm's length rate of rental. Look, another exception is a self-managed fund can buy listed shares from a member at market value. Some of the tax advantages that self-managed superannuation funds enjoy. When you have money invested in your superannuation fund, it'll be earning investment income, interest, rent, dividends, and maybe some capital gains if you buy and sell shares or property. You may also be contributing to the fund, personal tax deductible, undeducted contributions, or your employer contributions may be going into your fund. So contributions that are claimed as a tax deduction by you or your employer are taxed at 15%. Non-concessional undeducted contributions are tax-free, not taxed when received by the fund. So while accumulating in super, the investment earnings are taxed at 15%. Capital gains realised, if you've owned them investment for more than 12 months, is 10%, so that's 15% with a 1/3 discount. And dividends that are franked, the company will have paid 30% tax. The super tax rate's only 15% tax, so you receive a 15% tax refund on the tax paid on any dividend. Let's say you then retire after age 60, or simply reaching age 65 even if you're still working. You can commence a superannuation pension. If you're over age 60 at the time, that pension is paid to you and it's tax-free in your hands. You'll still have income coming into the fund, but a change occurs. So when your fund commences paying pensions, the investment earnings on those pension investments are tax-free. Any capital gains you realise by selling investments in the pension fund are also tax-free. And in the case of dividends from companies, the franking is fully refunded. So 30% tax paid, you receive a full 30% tax refund. So effectively living and investing in a tax-free world. You may also want to continue working and have no desire of retiring early. Transition retirement income streams allow you to commence a pension and to use it to supplement your personal income. Now, that can be combined with continuing to contribute to the fund. And as you can see, in the fund, the pension investments will have tax-free earnings and capital gains, and only the section that relates to new contributions will be taxed at 15% on their percentage of earnings. One often asked question is, can I buy or maybe even contribute a business premises I currently own to my self-managed fund? And also, can I lease it back to my business? Now, this is one of the unique features of having a self-managed superannuation fund. Looked at the rules before, we said that one of the exceptions is that a self-managed fund can acquire business real property from a member or a related party of a member. So, if you wanted to sell your business premises to your self-managed fund, or contribute it for that matter, the property, the land and the buildings need to be wholly used in a business. Not necessarily your business, but any business. Going forward, the property can't have any debt or mortgage on it before you sell it to the self-managed fund. The fund must acquire it based on a written valuation at market value. And if the self-managed fund is purchasing it from you, you must have the cash to do so. So alternatively, you may be able to consider contributing the property to the self-managed fund within your contribution caps. But some important things to realise is if you own a property and a business property and you can sell it to your super fund, when you do sell it or contribute it, you may realise a capital gain from when you first purchased it, because this is a sale. You'll have to pay, self-managed fund will have to pay stamp duty. It may also have to pay land tax on an ongoing basis, and you can't use that property for your business finance or borrowing in the future. That's an important thing to remember before you commit one of your biggest assets into a superannuation fund. So once your superannuation fund has the business premises, as I said, it can be leased back to you at market value. Now, the rent will be tax deductible to your business, and the rent received by the superannuation fund will be taxed at 15% if you're in accumulation fund mode. But if you're in pension mode, there'll be no tax on that rent, yet you get a full tax deduction for it in your business. So, borrowing is another feature unique to self-managed superannuation funds. Generally, self-managed funds can't borrow, but some special rules allow for that to happen. Now, let's say you're acquiring a property, the bare trust, a holding trust can be established to hold the title to that property. You borrow from a bank, the super fund receives the rent, it claims the interest tax deductions, and it repays the borrowing. On repayment of the borrowing, title passes to the superannuation fund. Now that sounds a bit tricky, but that's not where it ends. So some of the restrictions are listed there. A self-managed fund can only repair the property, it can't improve it. Now those rules came in to keep property developers out of self-managed super funds. So property development would be improving a property. That's why we're stuck with that rule. So you need to consider that in the property that you're purchasing. Does it need to be improved, or will you want to modify it? It can only be repaired. A self-managed fund can only borrow once on this property. So you can't use that property to borrow and borrow and borrow again to buy other properties. And consider the tax effectiveness. Interest deductions at 15% in a super fund, or maybe no tax deduction at all if you've got a pension fund. There's some of the things you need to consider if you're looking at superannuation borrowing. So there I'm showing the contribution limits. The concessional contributions are the tax deductible kind, and they are based on age. So if you're age 50 or more, you or your employer can put up to $35,000 into super a year. If you're under age 50, it's $30,000 per year. So for instance, if you're over age 50 and employed, that $35,000 cap includes the 9.5% compulsory superannuation that your employer may put in for you. Non-concessional undeducted contributions, well, that's private savings from your own pocket. Now, that's capped at $180,000 per person per year. If you're under age 65, though, you can bring forward that limit and do 3 years at once, so $540,000, but nothing for the next, over that 3 financial year period. The decision process, do you want a self-managed fund or not? Why do people establish their own self-managed fund? Well, control is one of the often mentioned features of self-managed fund. Choosing the investments yourself, including property, flexibility in implementing your financial strategies, not being part of a larger pool in a large fund, looking after your estate planning directly, and just generally being in control. Questions in the decision process. Do you want to take control of your superannuation investments? And if you're a busy person, do you have the time? You cannot take the self out of self-managed superannuation fund. It's very much you taking control. Making an informed decision. Do you actually need to see a financial advisor first? And what are the costs involved in setting up a self-managed fund? And estate planning is an important question. Who will receive my superannuation on my death? And you might be interested to know that your will does not necessarily control to whom your super will be paid in the event of your death. And that's the same in any fund, large or small. If you have a self-managed fund, who will be the trustee when you die? And so succession to the role of trustee of your self-managed fund is very important, particularly if you have married for the second time and have children from a prior marriage. What do we do at Henrik Curran? As well as being a large chartered accounting firm, we have a specialist superannuation division, myself, Clive Todd and Francis Hill, and a team of superannuation specialists. So we're accountants who are specialist super practitioners and part of the Self-Managed Fund Professionals Association of Australia. So our services include arranging for establishment of your self-managed super fund, the annual administration requirements, financial statements, income tax returns, minutes, resolutions, and those sorts of things, attending to the SMSF annual audit, then giving you ongoing compliance and taxation advice, and just generally being your mentor and coach to the self-managed fund rules and regulations. So we're not financial planners, and we're not licensed to give financial advice or advise on investments. So what we do is give you the facts about superannuation and help you make your own decisions. And then that ongoing role of SMSF trustee mentor or coach. That's what people seem to really want these days, is that they want to do their own thing with self-managed super, but they need someone to talk to about it, keep on the straight and narrow, and guide them through the rules and regulations. And in deciding whether you want a self-managed fund, we can be a good place to start because we can give you an idea of what is involved in establishing a self-managed fund, what you need to be careful of, and how you go about it. We can then point you in the direction of the relevant professionals, be that a lawyer, financial planner, insurance advisor, or stockbroker, and work together with those professionals to make sure you get the best outcome from your self-managed fund. The Australian Taxation Office puts out some very good publications for people who are thinking about setting up their own self-managed fund, and give you a very good idea before you proceed on what's required. And also the ATO has recently released some excellent video clips on help you make that decision about a self-managed superannuation fund. What's involved, what some of the tests are, what some of the rules are, and what the annual obligations are, for example. So I'd recommend that you have a look at those videos and give us a call if you have any questions. Well, I hope that presentation has helped demystify self-managed superannuation funds a little, and that this will assist you in making your decision as to whether a self-managed fund is right for you. Thank you.